Hey everybody, welcome back to my channel. So in light of recent events that have been going on concerning the Fed's more hawkish stance on monetary policy inside of the U.S., combined with the coming up debt ceiling crisis as we approach the end of September into October, I thought it prudent to do an update on my interest rate analysis that I provided on government treasuries, corporate bonds, as well as other types of securities, and see what the trend is showing right now to give us kind of an insight on where things are going. Now, if you've noticed here, the stocks have kind of been flat for the past week. I've been covering this in some of my previous videos. You can click on my channel and click on those playlists to watch some of those recaps and highlights to get the gist of things. But essentially speaking, in one of my videos, or maybe in a couple of them, I pointed out how the NASDAQ would be more prone or more sensitive to interest rate increases. So as interest rates start to go up on corporate bonds and government bonds, it would put downward pressure on the NASDAQ. And certainly the NASDAQ started to get hit today with lower prices. Also to take into note is that Bitcoin in recent days has also dropped in price. I think they went up a little bit today. I'm not real sure. Let me take a look at what happened to Bitcoin's price today, but they have been dropping last week because of bearish tones. Yeah, they went up a little bit today, and then they dropped. They did do a skyrocket, but then they dropped again as there's been the fear from rising interest rates. But yeah, that's definitely starting to have its pressure. The interest rates are starting to have its pressure upon the tech industries, which are more interest rate sensitive. So cryptocurrencies and the NASDAQ are beginning to feel it. So as the 10-year treasury started popping off and started increasing by 0.15 to almost 0.2% in just 3 or 4 days, that has led to a drop in the NASDAQ over the last 3 or 4 days. The same is probably true over Bitcoin. Let's see if that's right. Yep, right there. There's about 3 days ago. It was at 45,000. Then it traded notoriously lower. Tried to bounce back, failed, and is starting to taper off again. Definitely the interest rates are beginning to have the effect. And this 24th of September was probably at the end when the hawkish tone, the debt ceiling crisis was starting to take into effect. Also in the cryptocurrencies because China has clamped down and started to heavily restrict cryptocurrency lending. Their goal is to try to ban all forms of cryptocurrency trading as their economy starts to suffer from a potential deflationary crash. And they are doing everything possible to try to shore up the value of the yuan, respectively, by banning any kind of alternative forms of, or what they see as maybe alternative forms of currency or haven assets. So very interesting to see that here. Inside of the treasuries have been on an upward trend since they bottomed out in late July of 2020. I'll go into more detail into that in just a minute, but one of the things I wanted to point out is that there's a link between the 30-year fixed mortgage rate and the 10-year treasury rate. They tend to follow one another very closely. As a rule of thumb, the 30-year fixed mortgage rate tends to function as about 1.5% higher than the 10-year treasury rate, give or take. So right now, 10-year treasuries are at 1.47, 30-year fixed mortgage is at 2.88, but lo and behold, it has not adjusted upward since treasuries started having their initial push. So we could be seeing some rising mortgage rates, which might affect the mortgage industry negatively as time goes on. And as we have been seeing as an interesting phenomena develop inside the U.S. markets, we are in the middle of a huge real estate boom. Higher prices and higher demand for houses combined with limited inventory have really been just creating a shoot to the moon philosophy with a skyrocketing housing price inflation. And potentially now we could be seeing rising mortgage cost along with that, not just as a function of higher prices, but now as a function of higher interest rates, which could potentially deflate that bubble as time goes on. Do I think that's going to happen right away? Absolutely not. But given time and the mortgage rates adjust upward by 4 to 5%, it should definitely have a cooling upward to 4 to 5% should definitely start cooling that market very rapidly and potentially causing a bust. So keeping an eye out on that. Interesting to note is that AAA corporate bonds are just beginning to touch upward. So with 10-year treasuries the ones who are at the lowest interest rates with the same term are pushing upward more than the ones at relatively higher interest rates. So the corporate bonds are at 1.77. They did push up to 1.88, but that was only a 0.1% increase compared with treasuries, which pushed up by nearly 0.2% over the same period of time. Now, when we take a look at junk bond interest rates are usually very sensitive to deflationary or to credit defaults when those situations start to develop. And we're not seeing that right now. So the credit markets are seeming to be stable right now, because otherwise these junk bond interest rates would start to skyrocket, much like they did in 2020, much like they did in 2008. Now, granted, when they do start to pick up, it's a pretty sudden move. There will be a general trend to be pushed upward as risk starts to increase, but when the collapse starts taking effect, it's very, very sudden on these pushes upwards. So something to keep an eye out for, but that's going to be a late stage development that I don't see happening in the next couple of months. Now, when we take a look at the 10-year treasuries, in a previous video, and I'll post a link to that video in this feed below in my channel content, I did sort of like a spread of where the high could be on the treasury rates as well as the low. And I sort of had the low at this point trending this way, following this floor line upward. And it sort of broke below that. It's kind of broken below that previous floor that I've had. And it's, bottomed out in 2021 of July and August lower than what I anticipated, just based off the previous trends. Of course, this is not a science. This is more of an art and such. So now here's your new floor trend, and now it's beginning to push above that and is really beginning to approach this sort of median average line, trend line that's been going on in between. Notice how high the ceiling was going up as we saw this huge run up in interest rates caused by fears of inflation and heavy fiscal spending in the early parts of 2021. Then it turned right around and calmed down, in part because of the debt ceiling issues that we started having over the summer as debt started to be cycled out, and there was less government debt being issued into the economy versus the demand for that debt, both abroad and at home, along with the Federal Reserve purchasing $80 billion of treasuries off the market. Now, the Fed's still continuing to purchase that, but now that they've taken the hawkish tone that they are going to start tapering that back and ending that in the middle of 2022, certain investors are going ahead of the curve, dumping those treasuries and forcing up those interest rates. We're also seeing the Evergrande situation develop as potentially in the Asian markets who have been holding a lot of U.S. government debt. There may be some selling of that government debt in order to raise the dollars, to trade back into the yuan, to get a hold of that cash as they start entering a potential deflationary bust. We'll see that develop as the months go on, but that potentially could cause some upward pressure on the interest rates, at least in the short term. But I think the big effect right now is the debt ceiling, and then midterm is the Fed on that. So that could start pushing up those interest rates, which again could start pushing up the mortgage rates. And that's going to be a potentially problematic situation for our economy, because in the COVID situation, that what we've been seeing has been going on with COVID is that we are in a lower interest rate environment than we were before the COVID pandemic. And so because of this, businesses are used to having these low, cheap interest costs on borrowing money and debt. That is about to go away. We might start seeing a rise in those interest rates, and therefore a rise in interest costs combined with already inflationary pressures could start to hurt some of the industries inside of our economy, particularly in the producer industries, which have to borrow massive sums of capital up front to start making the investments and expanding their projects. And that could potentially cut short the boom, and if severe enough, start initiating a bust in our economy. Do I think that's going to transpire right away? No, but that's something to keep on our radar as we see these interest rates start going up. Now, in the previous months over the summer, I have been much more bearish about the interest rate tone because we were seeing this run up in interest rates, but due to the debt ceiling debate that's been going on, I think that's kind of potentially held off that inevitable correction that we were seeing. Originally, I thought that higher inflation would force up these interest rates, but now do I realize that many investors were already pricing in that inflation would be temporary and transitory. Now that we have these short-term crisis situations going on, it's causing some volatility inside of the bond markets. That might eventually settle, but overall with a relatively less loose monetary policy, so it's contractionary monetary policy in the sense that is not as expansive, not as expansionary as it was in the previous year, that could have some upward pressure on interest rates and could cause some problems in our economy as we are heavily debt dependent, both in the consumer industries and the producer industries. So those are some things that you need to watch out for in the coming months. Definitely could be deflationary for equities again. So we might be seeing a long-term quasi bear market in the stocks and equities on the U.S. front. Not necessarily in the terms of lower nominal returns or negative nominal returns, but maybe just lower nominal returns, especially when faced with inflation. In real terms, that is adjusted for inflation, they could actually be negative. So, I'll be keeping an eye on that situation. I'll update you as time goes on. I'll definitely be pricing this into my debt default model. I made a video about that, talking about that a long time ago. The debt default numbers should be coming out this week. I'm very, very curious to see what's been going on in the second quarter. I want to update those numbers. I know that for the actual default rates and delinquencies, they've been steady, and so that tells you that the economy is still stable. But looking long term, we could be seeing some instabilities down the road as this massive, massive credit bubble eventually turns to a bust, and that's going to have significant negative ramifications for our economy. But guys, that's my 2 cents on it. Let me know what you think. Make sure you drop a comment down below. I appreciate it. Let me know if you think I'm way off in left field, if I'm onto something. If you've got any questions, let me know. If you need me to clarify, I'll be happy to provide you as much insight and answers as I can. Click the like button if you like my content. Subscribe to my channel if you haven't already. Make sure you click that notification bell, and I'll talk to you guys next time.